McDonald's looks to be undervalued, down 10% year to date, showing some strong signs of upside, with both Seeking Alpha analysts and Wall Street analysts considering this a buy now. Today's episode, we're going to explain why it looks to be a very good price now to add to the portfolio. We're going to look at their total increase year on year on their top line as well as their bottom line net income. We're going to look at the health of this company, their total cash versus their total debt, and we'll see how they've performed over the last few years against some competitors in the industry. We also want to factor in their dividend safety, look at some important metrics like their free cash flow, their net debt levels, and also see both what insiders are doing, whether it's buys or sells, as well as the institutions. And we want to point out a few slides from their latest investor presentation about the outlook for this company. A lot of interesting pieces. And we'll also touch upon 3 reasons why from this latest article from Motley Fool, they believe McDonald's to be a strong buy now. A lot of this we will run through ourselves. And don't forget, as always, we will run this company through the valuation model, so we get to our own intrinsic value as well as our acceptable buy price when factoring our margin of safety, and see what Wall Street are forecasting for the next 12 months. Now, firstly, we just want to remind ourselves of the historical performance of this company. It is down around 10% year to date. When we do look at it over the last 12 months, still down 6.3%. And we can see over the last 10 years, without factoring dividends reinvested, it is up 166%. Now, we do note it does trade towards its 52-week lows with a yield of 2.5%, and we can see a forward PE sitting around 21.7. Now, before we do take a look at the analysis, we just want to point out 3 reasons now from this article to buy this stock. Now, we're going to go into each of these reasons in more detail, but at a very high level, the first reason is their cash flows. They are increasing their free cash flows year on year at a very strong rate, which is very important to understand. This is one of the main things you should look at when you analyze any company, are those increasing free cash flows year on year. The second point here, it talks about their profit margins and how they have some very strong operating margins. We're going to look at this in detail, but again, not only do they have a very strong profit margin, but also year on year it is increasing. And when we do look at the financial outlook, we're going to be able to show you that they are also anticipating increases to their margins over the next few years. Third and finally, what this episode is about is that the price is right for this to be a strong consideration for your portfolio. And as we can see, it has taken a hammering, literally 10% just over the last few months. So in terms of the performance of this company, top line, what we like to see, growth of 3 to 7% year on year. What we can see, December 2014, 27.4 billion on their top line. When we look at their latest annual accounts from December 2023, we can see 25.5 billion. So in fact, it has decreased over the last 10 years, and it is very inconsistent when we take a look at it in a graph format. In fact, their top line did decrease from 2014 down to 2020 before starting to pick back up again. So we will factor this into our valuation. But one thing to understand with this company, over the last 10 years, that top line growth has been very inconsistent. Now, in a better tune, what we can say is their bottom line has performed very strongly, 4.7 billion in 2014, and this has increased over the longer term to around 8.5 billion. So whilst they have struggled to increase their top line revenue, we do note their bottom line net income has been increasing over the longer term. Now, what's important to factor in is the health of this company, their total cash versus their total debt. And what we can see here is their total cash and short-term investments has increased from around 2.1 billion in 2014 to 4.6 billion. And when we do take a look at the graph over time, very inconsistent, although it has increased over the 10-year period. Not a massive indicator of the business until we do take a quick look at their total debt, both numerically and directionally. 14.9 billion in 2014, and their latest report 53 billion. So in fact, their cash has increased, although marginally, whilst their total debt has increased quite significantly over the period. Again, that is something we will consider when we do look at their dividend safety. Now, in terms of how they perform versus others in the industry, now we have here Starbucks, Chipotle Mexican Grill, DoorDash, and a few others. What we can see is over the last year, including dividends reinvested, they are in the middle performers, down around 4%. When we extend it to the last 5 years, we do in fact see they are the second best performing, up 57%. And when we really zoom out to over the last 10 years, What we can see with MCD is that it is up 245%, still coming second to Chipotle Mexican Grill, which is up 462%. Nonetheless, in isolation, a fairly strong return over the last 10 years, but do factor in that past performance is never an indicator of future performance. Now, looking at some new metrics, we have some growth rates, and what we can see, they do get an overall C grade. Few things that we want to point out from here. Year-on-year growth, 10%. Now, this was above the sector median of 3.3%. Forward-looking, 7.13%, again, higher than the sector median. And we can see in terms of their growth overall, it is looking very strong, as well as looking on an EBITDA metric basis and an EBIT growth. The only thing that we can note here that is lower than the sector median is their earnings per share forward-looking in terms of their long-term growth rate, increasing around 7.6% year-on-year, whilst the sector has done significantly better at 11.7%. Other than that, overall, the metrics are looking fairly healthy in terms of the growth aspect. When we focus onto the profitability aspect, we have a grade here of A+. We can see their margins very strong, as we highlighted briefly earlier. 57.12% above the sector median, and we can see the same applies to both the EBIT margin as well as the bottom line net income margin, which is very important. So overall, a very profitable business when we do look at it in isolation in just terms of the margin. Now, before we do look at their dividend safety, a few other key things to note. Insider ownership does sit around 0.18%, around 16 million worth of sales by these insiders over the last 12 months. When we take a look to see who these specifics were, we do know the same insider did sell a few times over the last few months, totaling around $2 million, as we can see here. Nothing really to note on here other than the fact that insider selling isn't necessarily a bearish signal. Different investors will have different views, but also understand they may sell for reasons that we're unaware of, personal or financial. Now, in terms of institutional ownership, 70.3%. We do know 8.9 billion worth of sales by the institutions, with a lot more buys by these same institutions over the same period. The only thing we would highlight is that in Q1, whilst we don't have the full data set, what we do know here is that there was more selling by the institutions, 142 million versus 33. So do factor that in if you want within your own investment thesis, but also remember institutions, insiders, always do your own due diligence, never copy what anyone does. Now, just to let you know, we have released our latest free weekly article. If you want to gain access to this, as well as all other articles, all completely free, do click on that pinned comment below where you can jump straight in and read. Our latest article, we do talk about 10 undervalued dividend stocks that show strong undervaluation, both on dividend yield theory as well as on the forward PE basis. Now, what we wanted to pull out, we wanted to look at their latest investor presentation, and in particular the financial outlook. Now, this was released a few months ago, but still a lot of things that are very important to note. First one, for those that didn't know, 80% of McDonald's were franchised in 2013, now 95%, so that is quite a significant increase. Something just to understand about the business model, a lot of them that you do see are franchises. Now, in terms of restaurant growth, now they were expecting around 50,000 restaurants by 2027. Right now, it is around the 35,000 mark. What they are looking is around 4% increase in 2024 in terms of growing those restaurants, with 5% growth in 2027. We can see out of their restaurants, they are looking at opening around 900 specifically in the US. So quite a lot of interesting information that I thought I would bring. The second thing that they are looking at from these new restaurant openings, they are expecting them just in 2024 to be an additional 2% to their top line. And from 2025 onwards, they are expecting around 2.5%. So we can see why they are looking at bringing out more and more of these franchises so that they can increase their top line. And the expectation is that it will increase around 2% in the full year accounts this year and 2.5% moving forwards. Now, taking a look at the margin, 43% operating margin in 2019. They've increased it in 2023 to 47%. And what they are expecting in 2024 is the mid to high 40% range. So at a bare minimum around that previous year's numbers. But it is quite interesting, and we will look at the details that they are increasing their margins. So we are seeing some nice signs of operational efficiency within this company. Finally, what we wanted to point out is their free cash flow. They are expecting to continue to increase their free cash flow year on year with a 90% conversion rate, which is very strong. And now let's take a look at those metrics so you can understand what we are referring to. So firstly, dividend safety score 77. It does look to be safe. Market cap 195 billion. It is a mega cap company. Now, in terms of some key recessionary metrics, while they increased the dividend during the last recession, they had negative 6% sales. Bear in mind this was above the average growth, given that did sit around negative 12, and a phenomenal statistic, a negative 3% to your portfolio if you hold MCD during the recession, whilst if you held the S&P 500, you would be down negative 55. So definitely a recession-proof stock based on historical data. Now, dividend growth, what I quite like here with this company is those nice dividend increases. 10% in October last year, 8% on average over the last 5 years, and strong double-digit increases over the last 20. So you could argue this is a strong dividend growth company. On top of that, whilst they have been increasing the dividends for the last 47 years and are a dividend aristocrat, they are 3 years away from becoming a dividend king, something that in this point in time does just seem inevitable. Now, in terms of dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. Today, we have a double undervaluation signal with the yield being higher than the 5-year average, as well as the forward P now sitting at 21 below the 5-year average of 25.4. But do bear in mind, we're not looking at any of these models in isolation and will conclude towards the end. And we can see the consumer discretionary sector P does sit much lower at 14. Now, in terms of the free cash flow payout, whilst we do focus on that as earnings is susceptible to manipulation by management through accounting, and you can look at that data, we want to see below 50% for restaurant industry. For me personally, 60% as a blanket rule, as that does give me faith that management are able to effectively allocate their capital. And what we can see here is it has been decreasing over the longer term, 63% in 2023. In a positive tune, effectively 55% in 2024 expected, meaning that we should see a nice double-digit increase to their dividend. In terms of free cash flow, as I mentioned, it is important that this does continue to increase year on year. Whilst a little bit inconsistent, more than doubled over the last 10 years, expecting to go higher in 12, 10 in 2024. So sales growth, as we did mention earlier, this is just another format, but we can see they have struggled to continually increase their top line. Last year, however, was a very positive year with double-digit increases, and they are expecting this to continue. In terms of shares outstanding, well, they do return that excess cash. We can see, in fact, decreasing over the longer term, although it has slowed down in the more recent period, effectively giving you more control or more portion of the company. Total sales, again, we can just see what we have previously discussed. In terms of ROIC, above 10% for my own rule, just to give me faith that management are able to effectively allocate their capital, and it is consistently very high. The last 3 years in the low 20s. As we always say, when investors or potential investors see this, this is something they do like to see. Operational efficiency, as we mentioned earlier, you can see they have been increasing those margins year on year. That is a very positive sign. And the same could be said for the free cash flow, where we look for a minimum of 5%, 29 in the latest year as well. This definitely does look like a very strong stock to consider. Now, net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, does signal to us both dividend safety as well as that balance sheet strength. So one thing we would say is that whilst the dividend is just having a safe score, we want to see below 3.5 for restaurant industry. 3.13 sitting there in 2023. What we know in 2024 is expected to come down to around 3, so it is moving in the right direction. We did note, however, in our balance sheet review that they were increasing their total debt at a much faster rate than we did see the increase of cash. But overall, it does look like moving in the right direction. So no real red flag indicators for this company. And as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now jumping into the first model today for the valuation, we do have the multiples valuation model. We have companies in a similar sector and PE as we can see here. With the average PE, we multiply that by the EPS of MCD to get an intrinsic value of $320. We have our first undervaluation signal. Do bear in mind we don't value a stock on purely one model. We then have the DDM model with the growth rate year on year around 7.6%. Forward looking, we have gone a lot more conservative at 6%. Based on this, we get the intrinsic value of $354, our second undervaluation signal. We then move on to the DCF model, where we have the free cash flow year on year, average around 9.4%, forward looking, analysts targeting around 11 to 12. And we can see here, based on the discount rate, we get the present value of the future free cash flow and terminal value, of which we add the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get there a third and final undervaluation signal. So the intrinsic value in today's episode for MCD is purely the average of these three models that you see on screen. $320, it becomes that value. Also, remember, you can grab a copy of the valuation model to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio and those on your watch list. So a margin of safety of 10%, as we can see, does indicate a buy at $288. When we take a look then at 15%, bearing in mind we use 10% if we believe it meets three criteria: the wide moat, strong financial metrics, and good forward-looking data. It is still a buy at 15%, up to $272. At 20%, it isn't quite there yet at $256, but it isn't too far off. So we can see for today's episode, it is between a 15 to 20% MOS level at this current value. Now, in terms of Wall Street and their forecast over the next 12 months, they have a price target of $324, a little bit higher than our intrinsic value. They see upside of 22%. Now, MCD is a stock that I do hold within my portfolio. It is one that I will add when I do see a lot more value, but right now it does look like it is a good price to enter. Anywhere between that 20% level, it is looking like a strong buy and very undervalued in my case and my opinion. However, I am interested to know your thoughts as well, whether or not this is one you are looking to add. Maybe you're looking to put it on the watch list at a certain price, or maybe this stock is just not for you. As always, let me know if you enjoyed today's episode. Smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.